let's get started. So I hope that everybody got a great weekend. Okay, and we are going back to the materials of module 3 about the process performance, right? So let me share with you the PowerPoint a little bit to see where we did last time. So last time we talked about the Little's law, right? Inventory equals the time times the rate. And first, we looked at this slide 20, where we see 3 examples: the U.S. immigration example, the champagne bottles, the tablet factories, right? So these are the basic examples because they already tell us the 2 metrics, and then we just info the 3rd metric. So it's kind of straightforward. And then on slide 21, we look at the word problems, right? So the large scale bakery example. So it's like a short story where we have to read, we have to extract the information, understand what they ask us, right? And then just do the calculation. And on slide 22, we talk about the baggage check-in. So they also give us some information, and at the end, we have to calculate the flow time, right? How long did the average passenger have to wait in line? So all of these are kind of word problems where we have to understand the information and understand what we have to calculate, right? So I hope that you can apply all what we learn here to many situations in real life, because in real life, a lot of things can be a process. And then we can measure the 3 metrics or the first 2 metrics and then infer the 3rd metric with the Little's law. Today, to really understand the Little's law, I would like to show you the ultimate example of the Little's law, through which I hope you really understand it. So it is on slide 23. We have timestamps of 10 customers who visited a local bank branch from 9 a.m. to 10 a.m., right? So think about this. This is a banking process where the customer walk in the bank and walk out the bank. And it's like we put a camera in the security camera in the lobby area, and then we can view the flow of customer in and out, right? And now we stay back and review the videotape. So we see that customer 1 walked in at 9:01 and walked out at 9:07. Customer 2, 9:06, and then out at 9:21, right? On and on and on. So these are called the timestamps that we can easily see in the videotape, right? So we have 10 customers walking in and walking out from 9 to 10 a.m. And we know what time they walked in, what time they walked out. So there are 2 big tasks in this question. Number 1, we need to calculate the 3 metrics independently. Okay, independently means you cannot use the Little's law at all. You have to calculate the inventory by itself, the flow time by itself, the flow rate by itself, by their definitions, right? And then finally, we after having 3 numbers, right? We see if the 3 numbers fit with the Little's law equation or not. So that's the 2 big tasks that we have to do here. One is the independent metrics, and 2 is we test the Little's law. So let me work on this with you. We are still in module 3 on process performance. We are still in the big topic of the Little's law. And today we start a new example. That's a bank visit process. Module 3, I think slide 23. By the way, what we're doing next is very similar to project part 2. Very similar. So I hope that I'm helping you with the project part 2 right now. Okay. So in this case, we draw the process as a follows. This is a local bank branch. It's just an office building, right? Where the customer walk in. And then at the end, they walk out. And just imagine we record the lobby area so that at the later on we can review the tapes, right? So after reviewing the tapes, we have to do the following. We need to calculate the inventory. The inventory is how many customers are still there within the bank, right? And then we calculate the average flow rate. Let me backtrack a little bit. We need to calculate the average inventory. On average, how many people do we see in the bank? That's of course, that's one of the things that we have to do. We also have to calculate the average flow rate. Right? On average, how many per hour, per minute, or anything. And the third metric is a flow time. By the way, it has to be the average flow time because the Little's law only works with the averages. Okay, so among these 3 metrics, let's start with an easy metric first. I would say the flow rate. The flow rate, in this case, is easy because they say that from 9 a.m. to 10 a.m., right? We have 10 customers. So the flow rate here is just 10 customers per hour. When we say per hour, in mathematics, it means that divided by 1 hour, okay? So this is an average number. Based on this average number, we can scale it up or scale it down. For example, you can do half an hour, you can do every 5 minutes, or you can do every minute. And later on, we need to have the number per minute because the flow time, we're going to measure it in minutes, okay? So in this case, instead of 10 customers per hour, I will do that as 10 customers divided by 60 minutes. So just an easy calculation here, 10 divided by 6 is going to be 0.166666 to infinity. So we have to round it to 0.167 to make it short. So customers per minute. Right? If we talk about 5 minutes, we just multiply 0.167 by 5. And we know the number of customers going through every 5 minutes, right? So again, this is an average number. You can scale it up, scale it down, depending on the time units that you are interested in. All right, so that's the first one. It is easy, so we got that one first. The second one, you know what, is called the flow time. Remember, this is an average flow time. So again, we have to calculate the averages because the Little's law only works with the averages. In this particular case, we saw 10 customers. Then actually, we can calculate the 10 individual flow times of the 10 customers, right? How? For example, customer 1 walks in at 9:01, walks out at 9:06, 9:07, right? Customer 1 walked in at 9:01 and walked out at 9:07. Then the flow time for customer 1 is 6 minutes, right? We do that for the other 9. So we have 10 individual flow times. But that's what we are interested in. That's not what we are interested in. We are interested in the average, right? So the concept here is the following. We calculate the flow time of customer number 1, and then calculate that for customer 2, customer 3, on and on. to customer 9, and then customer 10. Okay, we add all of them up, divided by 10, then that's the concept of the average flow time, right? We have the 10 individual flow times, but we need the average. So that's the concept of how to calculate the average flow time, right? So I would like everybody to try. We already know the customer 1 already, so let me write out for you. In this case, customer 1 will be 9:07 minus 9:01, then we have 6 minutes, right? How about customer 2 and customer 3? Please feel free to share your answer in the chat window. What would be the flow time of customer 2 and that of customer 3? All right, so I got it from Elita. That's customer 2. How about customer 3? Elita, everybody, please give me one number for customer 2, another number for customer 3. All right, good. I see that. Okay. What about other students? Yeah. Oh, Philip, you talk about the customer 4? Oh, yeah. That's correct. Yes, that's correct. Okay, so yeah, even though I only have from 2, but I think I believe other students can also do it, right? So I got it from Christopher. Also 12 minutes for customer 3. Good. Yeah, so just looking at the chart, and then we calculate how long each of the customers stay in the bank, right? So customer 1, 6 minutes, customer 2, 15 minutes, customer 3, 12, right? You can go on and on more. I just write here representatively. And I hope when you redo this example at home, you do all of the details, okay? How about customer 9 and customer 10? Please feel free to share what you got for customer 9 and 10. Customer 9 might be not that long, Elita. Okay, good. I see your correction. Good. Everybody else, customer 10, 4 minutes. Good. Right? Everyone else, we are just looking at slide 23. We subtract the time in from the time out, right? And then we know how long each of the customers stay in the bank. So I also got it from Jaylene. Good. All right, so I hope now you know how to do it, right? So customer 9 is 15 minutes and customer 10 is 4 minutes. So we just calculate the 10 individual flow times and try to average over those 10 numbers, right? We add 10 numbers divided by 10, then we get it. So at the end, we have the following. 86 minutes divided by 10. So the flow time, the average flow time is 8.6 minutes. You cannot say 8 minutes per customer, anything, because the flow time just tells us how long on average, right? A customer will stay in the bank. So the average flow time in this case is 8.6 minutes. Whereas the flow rate, it has to be per something, right? Because that's a volume per time unit. Otherwise, we will not know how much it flows through. All right, so we got the first 2 done. And now we need to find the third metric, which is the average inventory, okay? So what is the average inventory? It means that we have to make the counts multiple times for example, in 1 hour, and then average among the different counts to have the average inventory, right? So let me work on that with you. So conceptually, the average inventory is I1 plus I2, meaning that we count it at time 1, we count it at time 2, on and on. In this particular case, I would like to count it like 60 times. So we're gonna go from I1 all the way to I60. So 59 and then I60, okay? So we're gonna count it 60 times and average over the numbers. So I add them up, divided by 60, right? Then this will be the average inventory, because we do not talk about the individual inventory at one point in time. We are calculating the average among different points in time. So for you to imagine what it is, let me draw a picture for illustration. So I draw a timeline right here, right, from 9 a.m. to 10 a.m. Either you look at the lobby area of the bank, or you look at the videotape, right? Then that's a window from 9 a.m. to 10 a.m. So the 1 hour window in that particular morning. All right, we know that an hour has 60 minutes, right? So I'm gonna cut here the first minute, cut here the second minute, on and on. We do not have space to do 60 minutes in full, so we only do some minutes representatively. So 901 right here, 902 here, right? These are points in time. It is not a span of time. It is a point in time. And then 958, and then 959. Okay. So we have 60 minutes, but I only have space to show you 4. All right. So naturally now we have multiple points here where we can do the counting. But it's going to be confusing if we choose this point. For example, customer 1 walked in at 901 and walked out at 907, right? So if I choose this point to count, then I don't know if customer 1 was in or out. It's ambiguous, right? So we consider customer 1 as in or out. So that's why I will not choose this point. I'll choose the point in the middle so that I can avoid that confusion. All right, so the point that I would like to count here is the following. So the first point is 9:00 32nd. All right, that's a point in time that I would like to count. And then the next point is 9:01 32nd. Another point in time. I'm not trying to do the rocket science here. Okay, I do not try to have something precise here. I only try to avoid the confusion. So I try a special point so that we do not have to deal with the confusion. All right, so on and on. So 9:02, 30 seconds, 9:03, 30 seconds, on and on and on. And then choose another point right here, which is 9:58, 30 seconds. And then that last point is 9:59, 30 seconds. Okay, so we choose the middle of the minute to count. And because we have 60 minutes, so we have 60 middle points. And that's why at the end we have 60 numbers. We add them up divided by 60 to have the average inventory, right? So that's the point of why we have the 60 points here. Okay, so here's the thing. Now we need to look at the timeline. We look at the red points right here and just pause the videotape at exactly those points. So first of all, we pause the videotape at 9:00, 30 seconds and ask ourselves, how many customers we would see in the videotape at that point in time. Well, technically, we call it as what is an inventory at that point in time, okay? We're not counting the bank clerks. They would be there all the time. We are looking at the customers, right? So I would like to ask the whole class, just imagine that you are watching the videotape right now of the lobby area. How many customers would you see at that 9:00, 30 seconds? Please try and share in the chat window. I got it from Ferdinand. From Theo. Oh, by the way, we are looking at slide 23 right now, okay? We know what time the customer walked in, what time the customer walked out. So we are looking at 0.900 30 seconds. How many people would you see in the bank at that time? All right, so Elita gets something different from before. Jaylene also different, right? So at least we have two camps here. Whenever we have two camps of thought, we have to think harder about what we have, right? William, 0 again. You know what it is? This is the first time that you have to do something like this. I know it's confusing. It's not that straightforward. So just try whatever it is. I really appreciate your contribution. Okay. And by the way, it's very similar to what you would do for project part 2. So hopefully what we do here will be very beneficial for you when you do that project part. All right, I got it also from Christopher. So some of you said 1, some of you said 0, all right? All right, so think about this. When we look at that point in time, we should not see anybody in the bank yet because customer 1 walked in at 9:01, right? So we pause the video before the customer 1 walked in. So that's why we will not see customer 1. Customer 2 would not walk in until 9:06. That's why we do not see customer 2 either, or any other customers, right? So that's why at that point in time, we will not see any customers. Again, we do see the clocks right there, but that's not the flow units that we are interested in. Okay, we want to have more business, so we want to see more customers coming in. So, so the inventory number 1 is 0, right? I hope everybody sees that now. How about the second one? So let me write out here. I just continue our equation earlier, right? So inventory equals 0. How about the second number? At that point in time, how many people do you see? And actually, you can name the person that you see, right? All right, I see a lot of ones already. That's good. And that person is what? That's customer 1, right? Because at that time, only customer 1 was in the bank. That person walks in at 9:01, so definitely at 9:01 30 seconds, we only see customer 1. Customer 2 was not in yet, or customer 3 or 4, they were not in yet. Okay, so we only see 1 customer here. So the inventory number 2 is 1. How about inventory number 3? Okay, I don't have that point in time here is about like 1 minute from here to here, right? So how many people do you see at the third point? All right, so I got it from Alan, or other people, Alan, Elena, Sophia, Feren, William, Theo, Jose. Okay, good. Ing, Matthew, good. Emma, great. All of you agree. That's a good thing. And of course, all of you are correct. Just imagine who that person is in the bank at that time. We still only see customer number one, right? Customer one only walked out at 9:07. So at that point, we still see the same person. It's okay because we're talking about different points in time. So earlier we see customer one, now we see another time customer one. It is what it is, right? So the inventory here is one. And then on and on and on. Let me ask you, do you have the courage to go through all 60 points in time? I do have that courage, okay? So I encourage you to also do this at home when you have more time. It's a good thought experiment. It's a good mind kind of practice exercise. You just do another point, and see how many customers it was in the bank, right? And we are curious to know how many of them were in at any point in time. So I encourage you to do all of these at home, but here we do not have time to do it in full. So let's keep some points in the middle. I would like to ask you, what would be that of 59? What is inventory at that point in time? This point right here. At 9:58, 30 seconds, how many people did you see at that point in time? I got it from Alan. 2. Phil and also 2. Do you agree? Theo and Lita? Yeah, sometimes you have to ask yourself who that person is. Okay, so now I see another camp. Never mind one. That's fine. Now, whenever we see two camps apart, then we have to think harder about it, right? So how about other students? What do you think? Just ask yourself who that person was in the bank at that time, okay? Okay, so Christopher is more specific now. Okay, customer 9, yeah, you are correct. So actually, at that point in time, we only see one customer. It sounds like customer 10 is still there, but actually customer 10 walked out earlier than customer 9, right? Somehow the customer might split up and talk to different tellers. So it doesn't necessarily mean that customer 10 walked out after customer 9. Actually, customer 10 walked out earlier than 9, right? So that's why at that point in time, we only have one customer. And naturally, that customer 9. And for the last one, is easy. Let me work on this with you. At the last point in time, all the customer already walked out. So that's why we do not see any one inside the bank anymore. All the customer already, they were gone, right? So the inventory is 0 at that point in time. So again, there are 60 points here. Just imagine, it's a very long list of numbers. There's 0, 1, 1. At some point, you have 2, because 2 of them were in the bank at the same time in the lobby where you saw in the video, right? So 0, 0, 1, 1, 2, 3. Sometimes you have 3 customers, and then it goes down to 2, and then it goes down to 1, and then 0 at some point because nobody was inside the bank, right? So it is alternating between 0, 1, 2, 3, 2, 1, 0, things like that. So 60 numbers like that. And then if we add them up divided by 60, then we have the answer. So yeah, I did the whole thing. So here is my answer for you. 1.433 customers. Right? So on average, we have 1.4 people inside the bank. Sometimes less than 1.4, sometimes more than 1.4, but on average, it's going to be 1.4. Okay? And we call these as a calculated because we calculate that by ourselves or observed, right? Because we calculate it based on our observation. This is a manually calculated value, right? So we're done with the first task of the example, where we calculate the three metrics independently or manually based on the concept of the averages. But then we ask ourselves, do they stay up with the Little's law or not, right? So let's do the check. So this time around, instead of manually calculate the inventory, I will predict the inventory with the Little's law. Okay, so the Little's law says that the average inventory will be the flow time times the flow rate, all right? This is a very simple equation. Let's write out. So the flow time is 8.6 minutes. And then if you multiply with the flow rate, it's going to be 0.167 customers per minute. So the minutes will be canceled out. We only have like 8.6 times with 0.167 customers, right? So you know what? The 0.167 here is a rounded up number. If I just give it as is, 0.16666 all the way, okay? Then here is the answer. 1.433. That's a predicted value by the Little's law. And the two values are kind of exactly the same. Okay, one is predicted, one is manually calculated. I got this example from our textbook. So the author already kind of pre-calculated it so that it is a perfect example. Okay, but if it is just some kind of random sample, maybe the two values are not exactly the same like this, but they should be very close. Theoretically, they must be the same because conceptual the conceptual equation says that if they are averages, then they must be exactly the same. But if we work with some random data, then the two values should be close. They don't have to be exactly the same, but they should be very close. Okay, so I hope that when you do the project part 2, you're gonna see that if the two values, one is calculated inventory, the other one is a predicted inventory, stay close, then it means that you do it correctly. But if the two values are kind of far away from each other, right, then maybe you need to check what is going on with your calculation. Or sometimes, you know what, you start with the wrong definition of the wrong concept, and that's why the results come out wrong. Okay, so I hope that you would see that it's not too much difficult when you do the part 2. A leader. So in the project, you have to do exactly like what we do. First of all, you have to calculate 3 metrics independently of each other. Okay. So, and the fourth step is you predict the inventory, and then you compare between the manually calculated inventory and the predicted inventory to see if they are close or if they are far away from each other. If they are close, it means that you are doing it correctly. If they are far away from each other, you might want to check the definition, the concept, and the calculation. Okay. Anything else? Just excuse me. So I hope it's not difficult when you try this in project part 2, because now you already see the full steps to go through it. All right. So you know what? Sometimes it's so hard to find the third metric. For example, if you talk about retails, you have to track millions of items to know the flow time. You have to track millions of items to count the inventory, things like that, right? So that's why it's so hard to measure the third metric. And that's why we have to use the Little's law from time to time to help us, right? And I think the final part of the module 3, which we are going straight now towards it, is going to be about that. Is another important and I would say interesting application of the Little's law. So let me show you the slide first, and then we discuss it in more detail. Let me share the screen. It takes some time for it to show up. Let me. You know what? Sometimes it just 1 second, please. I need to do something for it to show up. Okay, so this is the last topic of the module 3. It is about inventory turns and inventory costs. So actually, this is in chapter 10 in your textbook. But I would say that it's so important. I would like to bring it forward right away. And because this is an important application of the Little's law. Okay? So in this case, we talk about the turns. What are the turns? So in retail, right? They buy the merchandise today, they sell it, buy the next batch of merchandise and then sell it. So each time like that, it is called a turn, right? So in a year, they turn over the merchandise multiple times. And the more turns it is, the more revenue that you can make, right? So that's why inventory turns is among the most important metric in the retail industry. Walmart, Target, Amazon, many other retailers, they have to track this number very closely because if it is going down, they have to do something to bring it up. Otherwise, something bad might happen, okay? Together with the turns, we also look at the costs because of the following. By nature, we cannot sell the merchandise instantly. It takes some time to sell. So during the time that the inventory stays on the shelf, right, that is going to cost us money. And later on, we're going to discuss why it costs money to keep on, to keep the inventory. So, so that's why in this case, right, we talk about something very important in the retail industry. And naturally, it is one of the applications of the Little's law. And I will talk about it. Later on, along the way, we're going to do calculation. So you're going to see all of the equation here. Don't worry about the equation for now. We're going to go through the equation with the Walmart real life data. Okay, so this is data for the year 2020. Let's call it as a pandemic year. It's a very turmoil year, and it's interesting to see what happens to Walmart. I also have the real life data for Target here. but we will not have time to do Target side by side with Walmart, right? So most of the time we work on the Walmart data. How did I get the data? I go to the corporate side of Walmart and corporate side of Target.com, right? And then just download the PDF file, and we have the data here. I will go back to the data. Let me discuss something first. So we are moving on to the last part of module 3. We are still in module 3, okay? Later on, when I gather the class notes, they are in the same module 3. That's why I will not write the module 3 here. So the big topic is inventory turns. And inventory costs. And we talk about the context of the retail industries. You can also adapt what we do here into manufacturing logistics, right? But during our discussion, we mostly talk about the retail industry. All right. So what is an inventory turn? So let me draw the timeline for Walmart so that we can easily imagine what is going on. So we take Walmart as our example. All right, so let's talk about the fiscal year. It ends January the 31st this year. So it means that the fiscal started somewhere last February, right? So till maybe February the 1st, 2020. So the bulk of the fiscal year landed in 2020, right? So that's why we call these as a 2020 data. Remember, for many companies, right, they choose the fiscal days to be different from the calendar year because they try to avoid the holiday seasons and they have to prepare the documents and books, right? So they do that after the holidays. So that's why the fiscal year for Walmart started February the 1st or something like that. Okay? So let's call that as the first day of the year, of the fiscal year. What happened on that day? They invest some dollars, right? So the dollar goes inside the process in the form of some merchandise. They use the dollars to buy some merchandise, technically. And then they put the merchandise on the shelf. It takes some time for that merchandise to get sold. During that time, the merchandise or the dollars are floating inside the system, right? So we call that as one turn. Oh, by the way, when Walmart sells a good and then get back the dollars, we make one turn. The dollar makes one turn in the process, in the retail process. And then what happens to that dollar? They reinvested that dollar right away, right? That's the nature of retailing. Investment, reinvestment, restock, and then sell and sell, right? All right, so that's the second turn. And then, of course, it never ends. They make another turn, they make another turn, right? So on and on, more turns in a year. So the turns happen again and again, right? So we call these as an inventory turns. The number of times that the dollars go in and out of the process and then go back in, right? Or the number of times that they buy the next batch of inventory, the next cohort of inventory, things like that. But just imagine, it's a very difficult process to imagine, right? Because we talk about millions of items going through and billions of dollars going through. So how to measure things, right? That's a difficult question. And later on, when we look at the data, we can understand more. So we talk about the inventory turn because it is crucial for the turns are crucial for survival and growth, right? So the more you turns, the more revenues that you have so that you can survive, right? If we do not have enough turns, or everybody else turns it faster than you, then you're gonna lag behind. Possibly someday you might need to go out of the market, right? So that's why the turns is crucial for survival and also for growth. So if we have more turns, then in 1 year we make the dollars go in and out of the process more. So we're gonna generate more revenues. And each dollar will come back to you, right? Because you reinvest at the beginning and then you get it back when you get the merchandise sold. So each time the dollar comes back to you, it also carries some profit on top of it, right? So together with more revenue, we have more profit. And with more revenue and profits, you can reinvest in the company, innovate it, do more online operation, catch up with the quality, things like that, so that you can compete more, right? It's all about the value that you can bring to the customers. So that's more turn, right? More revenue and more profit. And actually, there's a second good benefits of the more turns. So with more turns, then we can cut down the flow time, shorter flow time, right? In other words, the dollar will stay in the shelf in a shorter span of time. The merchandise gets sold more quickly, right? So because we can cut out the time, then we can lower the holding cost. If we cannot turn the merchandise quick, the items will stay on the shelf for long, and the longer they stay, the more costly it is for you to hold on to it. And I'm going to discuss that very quickly, very shortly, why it costs money to hold on to the inventory. Okay, so the tone is so crucial, right? It's crucial in the retail industries. Walmart, Target, even car manufacturing, all of those, right? The tone is crucial. All right, so I would like to discuss why it costs money to hold on to the inventory, right? Sometimes we do not think much about it, but actually it's a very important consideration. So cost of holding on to inventory. We walk in Walmart, Target, AutoZone, many other retailers, right? Stores. We see mountains of goods like this. It looks very good. It looks very impressive. But if you are the manager, you also have to worry about it at the same time because it means that we lock up a lot of money in the mountains of goods where it takes a lot of time to get them sold, right? And it costs money. So I have the list of the costs on slide 28. So let me go through that with you. So the first cost of holding on to inventory is called financial holding cost. Okay, so it means the following. Normally, the retailers will operate based on credits. It means that they do not use their cash of their own. They would go to the bank, borrow some money, and use the money or the working capital to buy the merchandise. And then they put the merchandise on the shelf and get the merchandise sold and then return the money to the bank, right? But during the time that you cannot, you're still holding on to the inventory. You do not pay the bank back yet, and you have to pay for the interest. And interest payment is among the biggest cost item in a retailer's accounting book. So this is an interest payment. This is a very big cost item for any retailers. Okay. So it means that the longer you keep the items on the shelf, the more cost it is for you to pay the bank, right? Like if we think about Kmart, they used to be the leader in the retail industry. But over time, we have Walmart, we have Amazon, we have many other stores. They innovate themselves, they coins, they turn over the merchandise faster and faster over time. Kmart did not catch up with that, right? They were lagging behind, and possibly because of that, they had to close down all the brick and mortar stores. They still have the online operations, but the store did not generate revenues enough. They did not turn over the goods fast enough. And the longer the merchandise stay there inside the stores, the more Kmart has to pay interest for the merchandise, right? For holding on to the merchandise. And that's why they decided to close down all the brick and mortar stores. Possibly online, they turn the goods fast enough to stay afloat, but not in the physical store. By the way, 2 weeks ago, I read another sad news about Aldi. Have you ever shopped at Aldi? It's a small grocery store chain. Okay, they sell food. They sell some household items. I think that they are based in Germany or something like that. They announced that they will close all the stores. Possibly they did not turn over their goods fast enough, right? The cost piles up, the interest payment piles up, the revenue do not come enough for them to stay afloat. So they will close all the stores. Okay, so that's the first cost of holding on to the inventory. Now we have to think again, right? When we see a mountains of good, it doesn't mean it is good financially. The second reason why it costs money to hold on to the inventory is called tangible depreciation. Tangible depreciation means that physically the good can deteriorate, becomes lower and lower in quality, right? So think about avocados and then milk are the food items at Walmart, right? So after 7 days or 10 days, the quality goes down, and then you have to mark down the price to entice people to buy up the remaining inventory. Otherwise, if it passes certain dates, you have to throw them out altogether, right? Because you worry about the litigation, you worry about other things, so you have to throw out. So either way, marking down the prices or throwing the goods away costs you money, right? So the more we hold on to the inventory, the more quantity that we hold, the more chance that we have to pay all of these, lose all of the money because of the tangible depreciation. It is the clearest with the perishable goods, right? After 7 or 10 days, things like that. But you know what? There is another kind of depreciation. So the items stay exactly the same, but the value goes down over time. We call that as intangible depreciation. Right? Intangible means the items stay exactly the same physically, but then the value goes down. And when the value goes down, we cannot sell that at the original price. So we lose money right there, right? It costs us if we hold on to the inventory. Let me give you a quick example. It is an exaggeration, okay? So, for example, you walk in an Apple store today, you buy today's or this year generation of iPhone, okay? The iPhone looks so shiny and beautiful. You don't want to use it because it will wear and tear, right? So you decide to keep the iPhone under the pillow for 1 year, right? It will stay there. And after 1 year, when you pull out the iPhone, it stays exactly the same. No dents, no scratches, exactly the same. Physically, it is the same item as the time that you buy it, okay? But then when next year, when you pull it out from under the pillow, the value of the iPhone goes down. And simply because Apple will put out a new generation iPhone, right? Then the current iPhone that you have become obsolete, even though physically it is the same item. So the intangible depreciation normally happens because of that, because of the obsolescence. The same item, but the value goes down. If you want to sell it, right, so that you can buy the new iPhone next year, you have to sell it at the discount. So it costs you money right there, right? So the longer that you hold on to the goods, the the more value will go down. All right, and that's why when you buy electronics, they will not give you 90 days return, right? If you go to Best Buy, you go to the electronics section of Walmart, normally they do it as 7 days or 2 weeks, something like that, because the technology becomes obsolete so quickly. So they don't want to take back the obsolete goods and then mark it out, right? All right. So that's the third reason why it costs money to hold on to the inventory. The fourth reason is theft and shrink. So the similarity between theft and shrink here is the volume of the merchandise goes down, and you lose money because of the reduction in the volume, right? All right, theft is one of the biggest problems that retailers will have to deal with, especially in the brick and mortar stores. If it is online, then technically, right, they cannot steal it from online. But actually, they can. They do all of the hacking, the credit card fraudulence, things like that, right? They can still do illegal things online too. But especially in the brick and mortar stores, uh, the retailers have to deal with that a lot. So that's why Walmart did an innovation. They put a greeter in the front door, right? So that greeter does a twofold things. Number one, they will greet you, assure that you are served when you walk in the store, right? That's the first thing. But then when you walk out, they will check your receipt, right? All right. So maybe I don't think that the intention of the greeter is to catch the thieves as many as they can, but they hope that by putting out the greeter right there, they deter any potential thieves, right? They know that they will be checked when they walk out, so they just become normal. They will buy things legally, and then they walk out as everybody else. So the deterrence effect right there will help Walmart to cut down the cost of the theft, right? It's not catching the thieves. It's about deterring the thieves to become the actual thieves. potential tip to become the actual tip. So, right, so that's one way to deal with it. But of course, it's not 100% perfect. From time to time, taps still happen in the physical stores. And when tap happens, right, the volume goes down by itself, and you lose part of the revenue because of that smaller volume or smaller volume of inventory than the original volume, right? Shrink is another thing very similar to that. So, for example, I put 5 flower vases on the shelf today. Okay, 5 of them, and because normally we cannot sell that fast, so the vases will stay on the shelf for a longer time. So the longer they stay on the shelf, the more chance somebody will knock it down the floor. So instead of 5 vases, now we have only 4, right? So the volume goes down. It costs us money because we do not have as much as merchandise as before to sell. Okay, so that's another reasons why it costs money to hold on to the inventory. Number 5 is called storage space and overhead costs. Overhead costs just means the following: the more inventory that you have to hold on to, okay, then you might need more resources, like more associate, more handling, things like that is going to cost you more to handle more inventory, right? Different layers of management to handle the inventory. So, so that's why if you can cut out the inventory, maybe you can save on the admin costs, right? Uh, about the storage space, there are 2 folds. One, it costs money to rent out the space to put the items on the shelf, right? We normally take it for granted. The stores nowadays are so big. We take that, oh, they have enough space, right? But sometimes they do not have enough space. Sometimes they have to put that in the back, right? If you, sometimes they have to put things in the bag, or during the holiday seasons, you know what, Walmart have to keep their stock in the containers on the parking lot, right? If you see that. Um, so space itself is limited, and it is costly, especially during or inside the downtown LA area. It's got a lot to rent out the space. But that's not it. Another reason why it costs money to put things on the shelf. So if you put an item on the shelf and it stays there for a longer time, then the second type of cost is called the opportunity cost, right? The opportunity to put another profitable item on the shelf and sell it. So it is twofold. One is it costs money to rent out the space for the inventory. And second, that's the opportunity cost to sell other profitable item. Okay. So number 5 here is about the cost of space and management. And the 6th reason why it costs money to hold on to the inventory is called so think about the pharmaceutical products, right? If you carry a big volume, then it takes a lot of time for you to draw the bottles, the vials, things like that to get them sold. And if the item had to stay longer in the inventory, then over time the quality will go down. The potency of the drugs will go down. And then at the end, you have to throw it away, right? I say throw it, but normally they have to reverse it to the manufacturers so that they can handle the chemicals. We don't want to put the antibiotics into the environment, right? So they will do reverse logistics with the chemicals. All right, so number 6, if we have longer wait time because we carry too much inventory, so it takes longer time for the inventory to get sold, right? Then in that case, the quality will go down. Sometimes you have to mark the price down. It costs you the discount. Sometimes you have to throw it away. You lose the total revenue of the items, right? So either way, it's going to cost us money to hold on to the inventory. So from now on, we have to think about it again. Walmart, Target, many other stores, they have a lot of inventory. It looks very good, but maybe they are costing their money because they are doing that, okay? Modern car factories, they try to minimize the inventory as much as they can. In the morning, the suppliers will bring in the tires for the car, they bring out the parts of the car, and then at the end of the day, they already have the finished cars and ship the cars out, right? So they try to minimize to hold on to the inventory. They do not carry much inventory in a modern car factory. Otherwise, it costs money. If they just buy different parts and put that in the back of the factory, what is the point? We lock up our money in the parts, and they will stay there, and they will not generate any revenue, right? So as a manager, you have to think hard about it. Carrying more doesn't mean good, right? It costs money to hold on to the inventory. So that's a big message that I would like to bring to you. All right. So it's time for me to show you the example one more time. And Marco, you talk about possibly collectibles, okay? But you know what? A lot of people, they try to sell the collectibles as much as they can because the value of those items will not go up over time. It's not like not Van Gogh paintings and things like that, right? They are just collectibles. If they keep the collectibles out, for example, the baseball card, something like that, there's a chance that the baseball cards printers, they print some more. The value may go down, okay? That happens. The collectors are so mad at the printers because they print them out more cards and the values of the cards go down, right? Of course, for some items, if the value goes up very fast over time, then it makes sense to hold on to them. But for many items, right, you don't want to lock up your money and then the increase in the value doesn't catch up with the interest that you can make if you have the cash on hand. All right, so yeah, so think hard about it. As a manager, we have to think about it. It doesn't always mean good when we hold on to a lot of inventory. Let me show you the example here. We will not have enough time to go through the whole example today. I just want to show you. Oh, by the way, earlier I already showed you the data. So let me start the table with you. So we talk about the Walmart data example, okay? Example, Walmart retail performance. This is module 3, slide 31. What we are doing next is very similar to question 21 in your homework. Okay, in that question, I ask you to go through a table. So let me draw a table here to mimic what you would need to do for that question 21. So we have a long table where the first part is about the information. Part 1 of the table is just some information for us to start with. By the way, again, I have the Target data, but we will not have time to do both Walmart and Target at the same time in class, right? So I encourage you to work on Target data when you have time. All right, so the first piece of information that we have here is the end of the fiscal year. We need to know that because we want to make sure that we got the right data. So here we talk about 2020, right? Then you have to find the documents where the end date, the end of the fiscal year is January the 31st, 2021, so that the bulk of the data landed in 2020, okay? So that's why we have to know the end of the fiscal year. And then they give us the revenue. The revenue, or we call that as the net sale. Why net sale? Because sometimes you have to subtract the returns, the discounts and something like that, right? At the end of the year discount because the customer bought a lot of volumes, something like that. So you have to subtract all of those amounts so that you have the actual flow of money coming in as a revenue. So that's why we call that as a net sale. Okay, so what is that number? 555,233 million dollars. Okay, if we have, for example, $1 million, it's a lot of money for us to count already, right? But here is not 1 million; it is $555 billion. It's more than half of $1 trillion, right? It's just an unimaginable big number of flows of money going through the supply chain. It's so hard for us to kind of comprehend it. But that's what's happening, right? This is actual data. So that's the net sale for Walmart in 2020. Okay. The cost of goods sold, that's the next concept. Cost of goods sold, or the acronym for that is COGS. Is $420,000 million. So to be specific, 420, 315 million dollars. So the cost of goods sold means that at the end, right, based on the accounting books, the accountants will calculate, okay, so this is the goods that we sell, then how much it costs that we invested at the beginning, right? So the investment at the beginning of those sold goods is called the cost of goods sold. It's just some calculation. It's not perfect. In accounting, they have to make a lot of assumption on how to count and how to measure, right? But that's $420 billion for Walmart, right? The difference between the revenue and the cost of goods sold is in the revenue, we have the cost and the profit. But in the cost of goods sold, we only have the cost of the initial investment in the merchandise, okay? And one more thing, the inventory, or INV, in this case, is $44 billion, 949. Right, this is the end of the year amount worth of merchandise in terms of dollars, right? So that's a huge number. It is not the average number. To be perfect, it should be an average number over 12 months or over 4 quarters. But this is the end of the year data. So that's a weakness of the data. So I would like to end the class here. We continue our example on Wednesday. Thank you all, and have a great rest of your day. And I will see you back on Wednesday. Okay?
Thank you, Professor.
See you, Professor. Thanks.
Yeah, thank
care.
you. See you on Wednesday. Yeah, take care. You take care too. Thank you. Save it. Okay, so I would like to thank you all, and I'm going to see you back on Wednesday.